it's mostly reflexive, right? So it's very fast, like reflexive up and reflexive down, and we all lived through multiple cycles in crypto. We know better than anyone else. Like you can never take it like a pattern for granted, because it changes. Like the moment the AI can captures it, it dissolves this, right? So the truly autonomous long-term kind of portfolio construction and asset management without human in that loop or provide oversight, it is more of a goal, like a fantasy at the moment, than the current reality and execution that teams, like serious teams, are executing right now. So that's my 2 cents. Mario, I know you have something to add.
Yeah. Yeah, thank you. Yeah, I would just like to echo and build on what the colleagues here have said. If you look at the layers that here we're looking at, we start from the rails and the connectivity that is relevant both for AI and for blockchain into institutions, to the orchestration layer, and then eventually the cognitive layer. Where we're focused on today is that rails integration, and as just mentioned, the orchestration layer, and improvement of the middle office and the operations. So we want to see things a little bit from a reality check perspective. We're still building the foundation and the building blocks. Yes, it's super smart at doing certain things, but as mentioned, actually traditional ML models for high frequency trading are better at processing a large set of data on a fast basis than traditional LLMs. And here we're also given for granted when we call AI, we go to LLMs immediately, but AI has been there for a long time. LLMs are one manifestation, very powerful of it, and so it already can do a lot on the moving faster from an organization perspective, integration perspective, with some caveats and some other risks, which we'll, I guess, address. But it's not yet that thinking brain that can do everything for you.
Agree with all of you, and I like how Andre in the beginning made a difference between AI hype and actual machine learning, right? Because in asset management, those are not always the same thing. And what you're saying is like super important. Machine learning already works well in high frequency trading and middle office operations, especially for monitoring, multitasking, optimizing yields in real time. But the fantasy that someone can open a public AI chatbot and suddenly beat the market for years, yeah, that sounds more like a movie than finance, or I don't know, funny reels on Instagram. And the boxing comparison, I like it. It's actually perfect because a normal person can throw punches, but competing with professional systems trained on huge data sets and infrastructure is completely different level. And yeah, at the same time, I think that people underestimate how much value AI already creates behind the scenes, because the biggest wins are often operational efficiency and not per se magical market prediction, as Pei said and Mario highlighted as well. And honestly, it's pretty refreshing to hear that someone in crypto says clearly that AI cannot predict markets perfectly, because sometimes this industry treats like every new tool like a discovered the crystal ball. But we're not there yet. Maybe someone, maybe a new startup, if any ideas, please connect with Witches and maybe you can create this crystal ball. We will be waiting for it. I think that we all can support you financially. But another question that I have for you today: as AI agents also begin to autonomously manage on-chain capital, or everyone claims that they started, how do you think about the trust and risk frameworks needed before institutions are comfortable delegating real assets to them?
Yeah, if
Yeah,
I may,
yeah,
yeah,
sure. Go.
Yeah.
yeah, thank you. Yeah, again, we are, if we look at where the adoption is, we're still now at the level of that integration of the rails. So if you look, and obviously, we also add two layers of regulatory complexity by saying on-chain AI, because we have the permissionless environment of blockchain, as well as permissionless AI management, or in any case AI management. So there are a few components to tackle. The one that has been the most worked on, and it's quite advanced, is the custody level. So we already have, and we are seeing now the integration of kind of the Web3 leaders that have built the infrastructure that is investment grade and that is being adopted or replicated by large organizations. And there's this convergence between kind of the traditional DeFi and TradFi with increased adoption, which has been very meaningful in the last 12, 18 months. And then you have the whole permissioning layer. How is decision making verified? How is it proven? Who does what? Where does the liability and responsibility of the decision lie? It's all yet to be formed. There's no golden standard yet. And then one important thing is, again, a standard for verifiable execution. The nature of blockchain is peculiar, but you have in the TradFi, especially institutional world, the need on one side for privacy of certain information, on the other side for verifiability of certain information. And so once again, that's something that needs to be tackled, which is happening, but it's still very early stages. And then the whole what model to use, how does it, like the whole AI management, AI stack management as well. And you overlay this with regulation, and you have quite a lot of barriers to entry still. So in terms of especially wide adoption, standardized venues, which is obviously an opportunity for market leaders and people that are working on it to build. It's still quite early.
Yeah, I think it's an excellent question, first of all, because there are truly two components that we need to get past for institutional level adoption. One is trust, and the second is the risk frameworks, right? And then Polly, you kind of commented on like when people actually think AI agents are doing autonomous capital management, that kind of reflects a lot of realities. Like at the moment, it's really hard. And there's an old saying of like trust but verify, right? The same thing applies to AI agents. When Mario kind of addressed that question, it's like there is a real need for verifiable computation, and with also the usage of zero knowledge proofs like ZKP knowledge technology in the middle of that, because essentially what we need to get to is like the ability to prove that an agent's decision truly followed a specific pre-approved strategy by the human team without revealing the proprietary logic, because that's kind of the secret sauce for a lot of prop desks and financial institutions and funds to actually be able to profit in a sustainable way, right? So that's kind of, the trust is kind of a very complex term that includes a lot of different layers. And then it is both regulation, both like technology, heavy kind of loaded question. And I wanted to kind of talk a little bit about how to build a risk framework, because I do think that there's some straightforward way to build guardrails and essentially like circuit breakers and restrictions that could be hard coded at the smart contract level. For instance, like you can easily set up a maximum drawdown per hour for your AI agent so that it doesn't lose your money within like 5 minutes, right? And then it could also restrict your AI agents to only interact with safe and audited protocols on chain, so that AI can just go to like a new lending market and deploy capital there. Those are some specific circuit breakers I can think of. And also obviously in the light of RSE's exploit and other hacks that happened in just the month of April, a lot of time it's just about stop loss, right? If AI agents is giving clear instruction that something start looking not right and money starts to like go out of the pool at a like very like abnormal speed, and you should stop, right? Like put like a lock there. I think those are some like really executable risk methods, and obviously like do a lot of simulation trading and against real-time data, but not historical data, because it's just like historical data isn't enough here. Before you grant any level of right access of your AI agents to capital. I think those are some basic, I think, practice, like best practice. And then finally, maybe we'll get to like a multi-agent world where, just like humans, right? You have checks and balances, but it's just much more efficient if you have an agent to regulate another agent or keep an eye on what they're doing as like a risk compliance officer type of role. So you can flag and you can veto transactions and without the group of agents deviating from the original mandate.
Yeah, definitely. Look, also like some from my side, right? But I would say that AI trading agents or AI in asset management on DeFi, right? It's not about decision making purely done by AI. It's efficiency improvement done by AI, because trading logic, trading strategy should be done by human logic, right? It's like scientific work. And then instead of having, I know, several people who are operating this logic, it can be offloaded to AI. But AI agents and AI technology on DeFi should work under like a very strict limitations, as Pei said, that should just follow strictly the strategy rules, should not have any permissions to decide which venue to trade or which new venue to explore, etc., etc. And I think this is the learning curve that the market should go through, because when this started, right, everyone was wondering that it would be cool that if AI agent could find great opportunities on the market, new platforms, new methods, deploy money, make money. But at the end of the day, it's very easy to exploit. Very, very easy, because you know the logic that people are looking for something big. It's automated. You just exploit this logic, run some bad software, and just collect this money and disappear, right? Yeah, that's it's less about AI agents do your work. It's more about AI agents follow your order. Yeah.
Pretty clear, and thank you for how I'd say it. I forgot an English word for it, but anyways, I think that's very important points that all of you said, because people often imagine AI trading agents as fully independent genius traders, when in reality, the safest model is probably the opposite. What you describing, all guys, sounds much more practical. Humans create a strategy, a risk logic, while AI handles execution and monitoring inside the very strict boundaries. Things like smart contract restrictions, maximum drawdown per hour, limiting agents to verified protocols make a lot of sense than just saying, don't worry, like, we have stop losses. And honestly, in DeFi, one bad interaction with the wrong protocol can destroy years of work in minutes. So these guardrails are not per se optional anymore. And I also like the idea that AI should be treated more like an operator rather than a decision maker, because markets are still too complex and maybe even emotional to fully automate without human oversight. So, and the funny thing is, the more serious the institutions become about AI agents, the less freedom those agents will probably have, which is actually a sign that industry is maturing anyways. But on another side, touching the TradFi, traditional quant strategies have been running in crypto for years. What does AI genuinely add on top of that? Where does it still fall short compared to human driven portfolio management? I think we kind of touched it on the previous question, but maybe we can dive deeper. Hey, maybe you can start here.
Yeah, I guess it's my turn to kick it off. So yeah, I guess the question was like, what does AI generally add on top of like traditional quant strategies and then the models that were robust and proven, like very profitable. and where does it fall short? Yeah, I think about that question a lot. I think maybe the newest, the most like net new value that AI introduces is a layer of adaptability, and then the ability to not just work on like historical and back tested data, but actually work with the current and fresh material, which means like this is essentially to say AI is able to have like a nonlinear pattern recognition that is based on unstructured data. So anywhere from like GitHub developer activities or some one-off proposals from the DAO, the governance, the community, the sentiment on Discord, Telegram, X, and news, right? And how to identify pattern by like consolidating all the information the AI gets from different venues and actually correlate it to price action and make a decision on trading and understand what is that regime shifts. Is it going from a bull to bear or the other way around? And more fluidly than like just like static, like data-driven quant model, which may not work very well in that situation. That being said, AI still is falling short in terms of when it comes like black swan events or complex context, right? Giving examples like when there's a regulatory change, AI might not interpret it as well as a human portfolio manager. Just understanding, having the history context of what typically would happen to follow a regulatory change is not something AI is better than human. I think is worse. And a geopolitical event happen, right? A bomb gets sent from one country to another. What does that mean in the macro setting? Like, what is that impact on the commodity price, the oil maybe, and the value of the dollar, right? And what does that mean? It then converts into asset classes, different asset classes, including crypto, but like much more deeper than that, right? Those are not in the historical trading models or data. So the common sense is essentially what AI is still pretty bad at, like when to stop trading well ahead of time, and when the fundamental reality or has shifted, not because the liquidity pool necessarily had like a structural change, but because the backdrop has shifted, right?
Yeah.
Valid.
Also, I completely agree with you, right? And what I'm thinking, right, that AI, like machine learning, whatever, right? It's everything about like velocity of decision making, right? And how fast you can evaluate a large amount of data, right? And I would say that in terms of competition between human and AI, in terms of asset management, right, then shorter period of time, then better AI works than human. Because if we are talking about public markets, let's say we need to trade day trading, intraday trading, for example, or while microseconds or milliseconds, there is no chance for human to beat AI. But if we are talking for longer time frames, and then a longer time frame becomes, then human has more advantage on AI because we can, for now at least, evaluate the context more properly than the AI machines. We can forecast that, okay, this, I know, war happens there is some communication there, and we can kind of imagine the potential future better than AI for now. But at least for now, yeah. I would say that the shorter the time frame, AI is better, than longer the time frame, human is better. But at some time frame point, nobody is correct. Nobody could predict future for 10 years.
I don't have anything to add. I think these are great comments, and the expertise of my colleagues is top notch.
Then, Mario, you will be first on the next question then. Sorry, guys, can you hear me now?
Yes.
Yes.
Okay, good. Today is a lucky day. I'm not sure why, but Thank you for the answers, Pei and Andre. And I think this is where the conversation about AI finally becomes realistic instead of science fiction as well, because traditional quant models were already powerful, right? But what AI adds now is kind of a ability to process fresh information in real time, as Pei said, connected with the market behavior, react incredibly fast, and the speed matters a lot because markets today generate more data in one day than traders could manually read in a month. So AI clearly has an advantage in velocity and scale, but also I agree with the point of black swan events because regulation changes, wars, geopolitical shocks are still very human situations, and markets react emotionally to them too. And AI can see headlines fast, but humans are still better at imagining second order effects and understanding fear, politics, this uncertainty beyond the data. So in a funny way, AI win in milliseconds, as Andrew said, but no longer, but on longer time horizons, the experienced human portfolio manager, I think that still has a very important edge, especially when the world suddenly stops behaving logically. Maybe we're on a way to another pandemic situation. I think that you all saw the news, so I'm not sure how AI will react on that. I hope not. I hope not, but you never know. Um, Next thing that I wanted to discuss, DeFi composability. And DeFi's composability means an AI-driven strategy can interact with multiple protocols simultaneously, right? Does that amplify returns, maybe systemic risk, or both? Mario, feel free to be
Yeah,
first on that.
sure. Thank you. I think, I mean, in short, both. I would rephrase amplify returns, which is more of an alpha generating kind of directional trading taxonomy, to enhance returns or enhance yield or risk adjusted yield. So as it's been shared during the call and the wisdom of the group, the ability of analyzing risk, finding information, identifying patterns, increases if well structured and architected. Therefore, you can see how AI, how well developed AI can identify opportunities that you could not be seen before, or identify opportunities faster, which is also very important. Being early is important, and so clearly it does allow to enhance opportunities and amplify yield. Um, the DeFi composability aspect is important with AI being able to kind of create synthetic financial structures, maybe again in a faster and more risk managed way, um, but also at the intersection of the adoption of institutions, I would say, given the RWA aspect of the discussion, where the DeFi composability component is still something that for institutional investors can be something exciting in this yield enhancement and kind of financial structuring aspect that blockchain and DeFi, as it's been built so far, is quite new and quite innovative. On the other side, clearly, as we said, we're adding an extra layer of risk to blockchain risk or on-chain crypto risk. Some examples of what could happen with AI, given that this is framed as a systemic risk. For example, we can imagine, and we're imagining a world with many AI agents. Let's imagine that all the AI agents are trained on the same public data, and there's many of them. They will all come to the same conclusion, and maybe the conclusion is wrong, or it's late. And so this could be a factor of increasing systemic risk, be all piling into one trade that then unwinds in an unexpected way, creating a void. So this could be an example. And also there are some infrastructural dependencies where in crypto, for example, the use of oracles is one that is often exploited, and one that still needs to be, diversified and with some redundancies in place to make sure that it's stronger and that hacks, even on a normal basis, are mitigated. And given that this is a data source for the AI agents, it becomes very important. And manipulation of oracles could also added AI with AI added on top of it could also enhance systemic risk. And also there's some funny things. We all know how MEV works, and so we could also see the rise of some kind of PvP style AI agent fights on chain, where they start kind of trying to extract value from each other on a net zero, if not negative sum way. So these are just some examples, but at the higher level, it's both. If well done, there are already opportunities today, but the whole architecture needs to be well built on the AI side and institutionalized on the crypto side for it to be a good environment.
Yeah, I agree. It's both. Like on one hand, there's going to be amplified return, because I do think DeFi's composability and modularity is perfect for AI, right? Because AI that's what it does the best. It can execute complex multi-hop strategies, borrow a loan, and then arbitrage across maybe like 4 different chains and 20 different protocols or platforms, just because there's a price discrepancy. They do this like more efficient than anyone out there, and then they can also hedge it simultaneously on the centralized exchange or platform. So I think that the amplified return is going to become a more norm, but along the way there's 2 things that will contribute to systemic risk or greater systemic risk. First is because all those protocols and strategy and liquidity are interconnected. So an AI-driven cascade or collapse is very likely event, because if one AI agent triggers a large liquidation on one protocol, it cascades to all the other, spills over to other platforms. You could depack and stablecoin asset, right? Like that was used as collateral on another protocol. So next thing you know, all the kind of liquidity associated collapse events that could reoccur, because the speed of the execution, that there's no time for humans to react, and that could potentially drain the insurance funds or any insurance coverage that you have. And I also think that the hackers are going to get better and better, right? Because using AI, they can just like so easily find the next like big OPSEC loophole or gap, and actually go at it where the most liquidity and capital is concentrated, especially on chain. So I think the systemic risk will be bigger. The sort of cascading events will be more frequent, and we already see that in TradFi. The trading in traditional finance is a lot of those like flash crashes are caused by algo models, right? And very rarely is like a one human trader like fat fingered anymore. That used to happen, before 2010, but now it's like algo models like malfunction or it wasn't trained like properly, and it caused like all those large losses across, banks on the Wall Street. So that will just repeat itself on DeFi and in the modern finance asset management.
Yeah, that's 100%. And adding to this, right, because most of the trading models, because systematic trading strategies are different, but they are similar by their nature, right? Especially in terms of risk management. And for example, we see something like black swan or some unexpected volatility happens, right? Our trading system kind of increases spreads or even take all liquidity out from the exchanges, right? And many other traders, they do the same, right? And then you have this flash crash because everything done immediately, and liquidity gone, and that caused even worse situation than it could be without this, right? And on the other hand, regarding hackers, right, I think this point is very important, and that situation that will have, and now have more and more advanced hackers attack It will even create more ties between humans and AI, because if you have only AI technology, I don't know, smart contract or whatever, which is driven only by AI and some script, it is always the risk for zero-day attack, right? And with AI agents, it's much faster to find these pain points or weak points and just crash the system. That's why I think everything related to large transfers and large funds will have or already have, and definitely from my point of view, must have some human checks, because humans can be hacked by social engineering, right? But technology can be hacked by like engineering, right? And we need to prevent both sides, and that's why we need to have both sides inside the technology.
Well, that was a tricky question because the answer is both, and this is a correct answer. Because DeFi composability is incredibly powerful for AI, as systems are amazing at multitasking. They can monitor yields, move liquidity, manage risks across several protocols at the same time, much faster than humans. And that, of course, create huge opportunities for institutions looking for better capital efficiency. But at the same time, every extra protocol connection adds another layer of systemic risk, right? And the example on AI agents trained on the same data sets, I think that Mara, you said that it's honestly a little scary because they could all make the exact same decision at once, and almost like giving thousands of very smart traders the same brain. Great in good markets, but potentially dangerous with the panic starts when panic starts. And Andre, very important reality check you mentioned, because every big technology wave also creates smarter attacks and more sophisticated hackers, right? If an asset management system is fully controlled by AI agent without human oversight, one mistake or exploit could spread incredibly fast before anyone even understands what is happening. I think that we already see this in crypto. A single smart contract vulnerability can lead to like millions of dollars disappearing in minutes. And I like that you keep bringing humans back into the picture, because experienced people can notice unusual behavior, context, or market fear that machines may completely miss. And I have one last question for you guys, but we don't have much time left, around like 8 minutes. We have some questions from the audience, maybe to answer some of the questions that people asked us. What do you
Sounds
think?
good.
Okay. Do you see the chat, guys, in the stream?
Yeah, now I see.
There is one comment from Matthew. Hi all, would be great to hear your opinion on agent readiness to interact with the protocols, whether you are focusing also on tokenized securities, not just crypto.
I think in terms of trading strategies, right, tokenized securities and I don't know, Bitcoin or DeFi yields or whatever asset management is the same, because basically you try to predict volatility in yield, and you trade symbols. It doesn't really matter what kind of symbols you trade. Yeah, interact with the protocols. I don't really get the question. What kind of protocols? Yeah.
Yeah, I think maybe, yeah, so Theoric is kind of currently very focused on asset curation of real world assets, especially starting with tokenized gold slash like precious metal commodity. So we have some conversations in flight, right? That is about this, because we do want to use a lot of AI for the curation process, and the curation largely involves interacting with protocols, which is the lending markets, the dexes, the exchanges, and hyperliquid, and across chain, right, bridging, and all that stuff. I think that's kind of maybe the definition of the protocols here. I think it really depends on the tokenized securities and how the securities are tokenized, because if you look under the hood, the tokenization of RWAs is very concentrated effort. So you can list with count with two hands who are the giants of like tokenize the securities today. That's like Securitize, the On-Do Finance. There's like Super, I think Superstay, and then Centrifuge. Like maybe there are a couple more, but those are kind of like the large ones, especially in the US side, right? So they will do it slightly differently. Obviously, some of them have like more licenses than others. Almost all of them involve SPV. So the structure of like how the securities are being tokenized or brought on chain, the genesis stories are different for different tokenization platforms, but they all eventually will get to liquidity facility. They need to get on chain and actually bootstrap the liquidity across venues like DEXs and exchanges and lending markets. So I think largely agents are ready in the sense like they are able to tap into, call APIs, deploy TVL, withdraw the TVL, move the TVL across different protocols. Those are very straightforward, vanilla, safe actions. Maybe they aren't necessarily ready to interact with all the tokenization platforms because like some of them are quite permission and private, and it's simply served currently. I would say like 90% of the tokenized securities are wrappers. They aren't necessarily like movable, transferable from day one, with a few exceptions, right? So from that perspective, this issuance layer aren't necessarily fully open and out there for agent to interact with, but some of them are more ready. So I hope that answers some of this question to a certain degree.
Thanks. Thank you, Pei. I think that actually a very smart and practical way to look at it, because from a trading strategy perspective, maybe a tokenized security is still just another instrument with liquidity, volatility, and like market behavior. But for AI or quantitative systems, in terms of how the asset is tokenized, is probably the key here, because it affects custody and compliance, settlement, counterparty risk behind the scenes. But I'm not a professional here, so maybe
from the buyer side, right? The LPs or holders of tokenized securities, they almost all demand some level of like qualified custody, right? The QC components becoming more important than ever. They haven't even got to the point of discussing what's the best optimal way to generate yields, but just like, is my asset safe with you? Who are you working with on the custody side? And I think that's very healthy, and it's like quite understandable approach because they need to clear internally from a legal and compliance perspective. But yeah, custody for sure. Thanks, Polly, for mentioning that. That's a really important component.
Mario, do you have something to add to the question?
No, I mean, I think it covers most of it. As on the asset side, as Andre was mentioning, actually these are somewhat tend to be more traditional assets. If you look at commodities or things that are already been priced in the traditional markets for a long time. So from a kind of trading analytics perspective, AI agents are ready for that. Now, as we go down the asset class list, and maybe we start tokenizing private deals, private credit, things that are more illiquid or do not have a public market on TradFi, there's a new market of intelligence to be built. And so actually what's most relevant is what Pei has been mentioning, so the kind of Rails integration again, and the accessibility of the execution layer to these platforms, the compliance alignment, because often many of these platforms are still behind compliance checks, and so it's more of a Rails and orchestration integration at the moment, and anybody can go through that pain, and if so, they're ready to go.
Okay, good. I think that I see some other questions, but maybe we can answer them in a text version via LinkedIn, if you will have some time to do that, because we are out of our time on air, and I think it's it's a great wrap up for our today's discussion. And I think that our today's conversation made one thing clear, at least, that AI driven DeFi asset management is not per se a futuristic concept, but it's already happening, right? Just not always in this dramatic robot finance way people imagine. It's still with the human touch. And what we're really seeing is the beginning of a new financial operating system where automation and intelligence and programmable assets start working together in real time. But also, as all of our panelists highlighted, technology alone is not enough because trust and regulation and security and transparency will decide how fast institutions actually can move. And of course, like we can not just remove humans from here. And yeah, I would love just to extend a huge thank you to Mario, to Andre, to Pei for sharing your insights and being willing to go beyond the usual conference buzzwords. And thank you everyone here at RWA Week for joining us and asking big questions about where finance and AI and blockchain are really heading next. Dear speakers, if you have some final words for our listeners, feel free to speak up.
I would like to say just thanks for being with us, listening to us, and thanks for questions. And yeah, it was interesting, and definitely AI, crypto, and financial world, they're here and for a long time. And it's very good that we can enjoy to be among the first um, um, explorers here.
Yeah, good conversations, good questions, good panel, and thank you for having me.
Yeah, thank you very much. This was fun.
Thank you.
Thank you so much, everyone. Well, enjoy the rest of your day, and hopefully by next year, maybe in the next 5 years, none of us will be competing with full autonomous AI hedge funds. But let's see. You never know. So, although I'm not making any kind of promises, thank you guys. Have a good rest of the day, morning, or evening, and ciao, ciao.